Howdy everybody, I'm Raymond Dahlman, President of DSA Financial Group, and this is the weekly economic update for April 26, 2021. I hope everyone had a fantastic weekend. The Astros took 3 out of 4 from Anaheim, which is always a good thing. Little lack of offense yesterday during yesterday's game, but can't win them all. And I guess being back here in Colorado has brought the good karma back to the Astros. So I'll take most of the credit. And anyway, so like I said, hope everyone had a good weekend. Tried to get some chores done here around the house, but let's see. I tried to install a new screen door off our sun porch, and it was about 1 inch too short, so I got to take that back. Tried to replace the rollers on our sliding doors on our the back of the house, and didn't have the right screw to attach it, so now I got to make another trip back into Castle Rock and go back to Lowe's and see what else. I was going to try and fix a can light in my kitchen, and that's going to require an electrician. So all 3 things I tried to get done this weekend were abject failures, and so is what it is. So anyways, let's go ahead and dive into the weekly update and see what's been going on. Let's see. Last week we had strong corporate earnings, but the fear of COVID-19 has kind of put a damper on things. The Dow Jones was down 0.46, the S&P down 0.13, NASDAQ was down 0.25, and international was down 0.47. So kind of across the board, the 3 major U.S. indexes and the international index were all down. Not terribly, but you would think with the strong earnings reports that would have looked a little bit better. So as far as a directionless week, the stock market, as I said, had a little bit of a decline. Some of that could be due to the current administration's plan to raise capital gains rates. I personally am very opposed to that. In my view, taxation is theft. I never consented to be taxed, and I just think this will slow things down as far as the economy. So housing looked a little bit better. There was strong demand. Sales in March jumped by 20.7% from February, and let's see, by more than 66% from last March. So, there's some things there that you could read into. Obviously, a 66% jump from year to year. A lot of that has to do with people moving around. You don't have to live in cities anymore if you're able to work virtually, and that has allowed people to move. Also, there was probably some pent up moving over the course of the last year, simply because people weren't able to get out and about as much. Let's see. All regions recorded double-digit gains except for the West, which had a 30% decline. From what I'm seeing just in my own research and from what I've been reading is that inventories of homes for sale have really tightened up. So that probably has something to do with it. As far as key economic data this week, we have durable goods orders report coming out today. Tomorrow's consumer confidence. Wednesday we have the FOMC announcement, and then Thursday jobless claims and GDP. Let's see, we have a whole host of companies reporting earnings this week. Some of the highlights: Tesla today. Tomorrow's Microsoft, Alphabet, Starbucks. Wednesday, Apple, Facebook, Boeing, and a whole bunch more. Ford. Thursday, we've got Amazon, Twitter, MasterCard, and Caterpillar. And Friday, we have AbbVie, Chevron, and Charter Communications. So we'll see if we continue to have a strong earnings reports coming out. But all in all, it's mostly good news coming out of companies. Here's a chart of the last week. Like I said, all the major indexes were down, but year to date, they still seem pretty strong. The 10-year closed at 1.58. It was down 0.01 for the week and down 0.65 for the year. So, all right. I only have one white paper going out this week, and it is what in the world are NFTs? And you've probably seen articles about it, or may have seen some bits in the news, or on some of your favorite news programs might have talked about them. But what is an NFT? Simply, in a simple definition, it's a non-fungible token. So what does that mean? What is the difference between fungible and non-fungible? In this example here in the white paper, if you trade one digital currency or coin with another, they have the same value. And so that, like dollar bills, $1 bill is the same as the other dollar bill in value. But if you were to have something that is non-fungible, let's say you have, in this example, two paintings. One is an original Picasso, and the other is something you got at a thrift store. They look identical, but one is because it's painted by a master, and the other by just some rando. They're not going to have the same value. So, and that's essentially what an NFT is linked to. It's linked to a digital asset that is recorded on the blockchain, and one of the people I listen to on a regular basis, Scott Adams, he has some NFTs that he has put out there. I would personally look at these as a very speculative market right now until you can really have a clear understanding of what they are and what they're valued at and such. So let's see. Let's go and take a look at we mentioned the 10-year. That's gotten a lot of news, the 10-year Treasury rate to be exact. And looking here on investing.com, you can see over the last year, Treasuries have continued to climb, nowhere near as high as they were, 2-3 years ago. And if we, jump back out even further, historically over the last, 50 years, those rates are extremely low. But we are hearing that Treasury rates are climbing. So let's go over to my dynamic yield chart, and we can take a look at where Treasuries are right now. And let me turn off the snapshot. So this is the current yield curve going from 3 months to 30 years. If we take a snapshot of where it is today versus going back in time last October, we see that the yield curve was lower. So we see that longer term rates have climbed more. And again, if we go back through time over the last year plus, we can see, at January of a year ago, shorter term rates were much closer to longer term rates. And over the last year, we've seen this decline. If we go back a little further, we can see where we were in September of 19. We can see how the yield curve dipped down and then leveled back off comparative to where we are today. So you'll see a lot of news about the yield curve and what different rates are doing over a specific period of time. But like I mentioned on previous broadcasts, that when the rates go up, typically that is because the prices of the bonds are going down. So the yield, it has if you're paying less for the bond and you're getting an X number of coupons, you're getting a better deal when the price of the bond goes down. So, all right, let's flip over to the trade balance. I know I've talked quite a bit about this in client meetings and also on a few broadcasts, but we can see here, going back 5 and 10 years, our trade balance has been very, very low. As of the February numbers, our trade balance came in at 71 billion, and from the previous month it was at 67 billion. Why is this bad? Essentially, it's because we're importing a lot of goods from overseas and pushing a lot of U.S. dollars out into the international markets. What has been the cause? Well, obviously, when we've cut production here in the United States so much over the last year, we still have those same wants and needs, and we're just buying more of them from overseas. So, skipping back out further, to the 25-year chart, this is as low as it's been, in the last 25 years, and if we go out to the max, going back more than 50 years, this is truly, the worst numbers we've seen in our trade imbalance. So, is it going to lead to economic destruction? I don't know. But just looking at the numbers here, it's certainly not ideal. I'd like to see, getting back to what was considered some normalcy back, 5-10 years ago. But again, something to keep a look at. It appears that our next report should come out in the first week of May. So I guess a week or two from now, we should see what the numbers look like. For the month of, I guess that would be for March. So, all right, that's about everything I had from a financial perspective. I did want to share, some a podcast that I had heard over. Well, I heard a gentleman who was on a podcast talking about his latest project, and it has to do with the Penn State debacle, I guess, or scandal from a few years back with Joe Paterno and Jerry Sandusky. This gentleman, his name is, John Ziegler is his name. He is a columnist and a journalist, and he has spent quite a few years researching this. And based on his research, he feels that this was all just a witch hunt, and there's a lot of evidence that Jerry Sandusky and Penn State were basically just had by people making false accusations. So his first, in the first episode, or the title of the series is called "With the Benefit of Hindsight." And on episode 1, he talks about the date, the date of Mike McQueary, who was an assistant coach on the team, and what he saw. And so it's an interesting listen. Going to go ahead and share this in the show notes page. And so I think he's going to have 13 or 15 different episodes. This first one is 2 hours and 26 minutes. So I'm actually going to listen to this first one this week, and I think there's a second one that's actually out on most podcatchers. So, like I said, something outside of politics and economics. Just some, kind of a good mystery on what really happened, and so I figured I'd share that with those out there, and hope you enjoyed. If there's anything I can do for folks over this week, feel free to reach out to me, give me a call, shoot me an email. And other than that, that's about all I had for today. And like I said, have a fantastic week. Get outside. The weather's getting nicer, even here in Colorado. I think we might even get up to about 70 degrees today. So get out, get some sunlight, get some exercise, and take care of yourself. So have a good day, and I'll talk to you later in the week. Bye-bye.